The biggest mistake that most people make going into the low season is that they're too late with adjusting their strategy. They kind of just see that open calendar and you're like, I have no bookings. Now you're slashing prices and you're freaking out. So what do we do to counter that is we get ahead of the curve, because controlling your pacing is one of the most important aspects of revenue management.
Welcome to Get Paid for Your Pad, the definitive show on Airbnb hosting, featuring the best advice on how to maximize profits from your Airbnb listing, as well as real-life experiences from Airbnb hosts all over the world. Welcome.
Get paid for your pad. Get paid for your pad. Get paid for your pad.
What's up, everybody? Welcome back to Get Paid for Your Pad. This is an episode of Rev Up, where we are going to give you insight into our revenue management strategies that we are using across 40 free portfolios I think we're managing now at Freewyld Foundry. We're going to give you guys some insights in what we're doing, what's working, what's not working, so that you can increase your revenue. So today's topic is low season strategy. Obviously, it's end of October, beginning of November. Most of you guys are probably going into your low season unless you are in a ski market, or if you're maybe in Texas. There are some markets where November, December, January, February, and March are actually very strong months, but the majority of you are probably going into your low season. And the low season can be pretty challenging, obviously, because occupancy tends to be very low, and you can kind of fall into a trap where if you don't get any bookings during the low season, it can actually affect your summer bookings as well. And it all has to do with visibility on the OTA platforms. So before we dive into that, if you are watching this on YouTube, and I highly suggest you do watch it on YouTube, because we are definitely investing into higher quality content. If you're watching on YouTube, you can see I have a new studio set up here, which I'm very excited about. So we're really upping our game when it comes to the podcast. And so we would love for you to watch on YouTube. Give us a thumbs up, give us a comment on the YouTube videos as well, so that we can reach more people. So anyway, let's dive into today's topic. So low season strategy. I'm going to cover 3 aspects of your low season strategy that I think is going to have an impact on your revenue. So the very first thing is pacing. All right, we've talked a lot about pacing on this podcast, because controlling your pacing is one of the most important aspects of revenue management. And it's also one of the hardest aspects of revenue management as well. Now, if you are familiar with our podcast, you probably know that our favorite indicator is market penetration index. Market penetration index will tell you what your future occupancy is compared to the market. So let's say your occupancy for the next 4 months is, let's say, 20%. And if the market is at 10%, then that means your market penetration index for your portfolio is 200% for the next 4 months, which is actually, going into your low season, that's actually a very good target for you to hit. So the biggest mistake that most people make going into the low season is that they're too late with adjusting their strategy. September, October, most markets, you're still getting bookings, you're still doing pretty well. And then suddenly after Halloween, it kind of drops off a cliff. In some markets, like it's a week later, because there's a weekend in the first week of November. I think it's Veterans Day. That's a pretty strong weekend in some markets. But then it drops off, November 8th or November 9th, it just kind of drops off a cliff. And most operators, they don't look ahead and plan their low season strategy in advance. They kind of just suddenly you see that open calendar and you're like, I have no bookings. And now you're slashing prices and you're freaking out. And I'm sure this sounds familiar for some people. I've been there myself. So what do we do to counter that is we get ahead of the curve when it comes to low season, right? So ideally you would have set up your low season strategy already, but right now it's not too late. What I recommend is, if you're not tracking your market penetration index yet, start tracking your market penetration index and aim to be ahead of the curve, meaning that you want to get more than your fair share of bookings early in the booking window. The reason for that is that the final occupancy in the market during low season is often around anywhere from like 20 to 50%, depending on your market. Some markets have a pretty decent low season. Like typically urban markets, even in the low season, will still see 40-50% occupancy, especially on the weekends. There's also some markets in the northern states, for example, the Great Lakes, Canada, the beach markets as well. Those are really, really tough markets in the off season where occupancy might drop all the way down to 20-25. Our goal for the low season is to maintain at least a 50 and if possible, 60% occupancy. Okay. The reason that we're very focused on occupancy during the low season. The reason for that is that, well, first of all, more occupancy is going to lead to more revenue in general, but also more occupancy will keep our visibility strong on the OTAs. So if you have a unit that doesn't have any bookings from November all the way through March, people start booking for the summer already, like in January, February. And if your listing haven't had any bookings for like a couple months, your listing is not going to be very visible. And so you're also risking your summer bookings, right? Your spring bookings. So the very most important aspect of your low season strategy should be that you're keeping the momentum going on the platforms. You're offering a price that's competitive enough to keep enough bookings going. Don't worry too much about the revenue necessarily that you're making during these months. Just focus on getting as many bookings as possible, keeping that momentum on the OTAs, keeping those reviews coming as well, because these reviews are also very important for the search engine.
What's up, guys? Eric here. And before we dive into this episode, I want to introduce you to our podcast sponsor, Freewyld Foundry. Freewyld Foundry is a revenue management service, white glove, high touch service for the top 1% short-term rental operators. We're currently managing over $60 million in bookings, 1,700 listings worldwide, and we are growing very, very quickly. Our RPM program is a done-for-you revenue management service, and I want to invite you, if you are a short-term rental operator that's doing $1 million or more, or maybe about 15 listings or more, head over to freewildfoundry.com and apply for one of our free revenue audit reports. This is where Jasper and the team will actually take a look at your pricing strategy, audit all of your Airbnb listings, and let you know if you're leaving money on the table. So this is free. To everyone who's listening to this podcast, head over to freewildfoundry.com and apply for your free audit report.
So how do you get ahead of the curve? What most operators do is they slash their prices last minute. So oftentimes when potential clients apply for a service, I look at their low season pricing and it's very high because typically people have far premiums and they have last minute discounts, but those probably kick in, 2 to 4 weeks before check-in. So early October pricing for November, December, January, February typically is at a level that's unrealistic to get more bookings than in the market. Okay, so pricing is typically too high. So what you can do is you can get ahead of the curve and you can reduce your prices now already. If you're using Price Labs, you can use a custom seasonal profile to do this, and you can just adjust your base prices and create seasonal base prices for your low season. And you could set your rates already now competitive for the next 4 or 5 months. Typically, the low season is over. Depending on your market, it's either President's Day weekend when things start picking up, or it might be spring break. It might be early April. And in some markets, it might be even Memorial Day when things really start picking up, right? So your low season might stretch all the way through Memorial Day, or it might stretch a little bit shorter until President's Day or spring break or whatever it is. But you got to look at your market and you got to chop up your season or your year into seasons and create those seasonal profiles. If you're using Wheelhouse or Beyond, I'm sure there's other ways to do that. We use Price Apps exclusively, so we use custom seasonal profiles. The reason that you want to do that and not change your base prices is because, and this is a mistake I see a lot, is like people freak out end of October, early November. They see that they don't have a lot of bookings for the next coming months and they'll slash their base prices. And what's going to happen if you slash your base price? Your price for the entire year is going to come down. That means your prices for the summer is also going to come down. And now you're going to get bookings for the summer at a lower ADR than you want, right? So we don't want to slash our base prices going into low season. We want to create a seasonal profile and only decrease those prices for the off season only. But do it now before the other operators are doing it, because if you're competitively priced now for November, December, January, February, you're going to get more bookings than your competitors, and so you're going to be ahead of the curve. Your MPI is going to go up, you should be targeting an MPI of anywhere from 150 to 250, depending on your low season. If you're expecting final occupancy to be lower than like 30%, then pretty much like get your MPI as high as you can. When the occupancy is that low in your market, you should probably just have your rates at your minimum price already, okay? Because the occupancy is just so low then that it doesn't really make sense to try and get a higher price than whatever you're willing to accept. All right, so be very, very aggressive. If your final occupancy is going to be around 30%, if you're then like your MPI is about 200, that means you're aiming for like a 60% occupancy, right? Doesn't mean that there's a guarantee that you're going to get there, of course, but if your MPI now is like 200%, as you go for your low season, you keep track of your MPI and you make sure you make adjustments if your minimums allow it, because depending on your minimums, you might be restricted by your minimum. You might be managing homes for owners who are not comfortable with a price below a certain number, and that number might be too high for your market, right? So in that case, you're kind of stuck. That happens sometimes. In that case, you might want to talk to your owners and tell them like, hey, if we don't lower the price, we're probably not going to get any bookings, and that's going to hurt our summer performance as well. So going back to your pacing, so very important that you get ahead of the curve, offer those competitive rates far in advance so that you can start getting bookings while your competitors have their prices too high and are slashing them last minute, right? When it's too late, especially in the low season, you cannot rely just on last minute. You can't book, you can't slash your prices last minute because there's just not enough demand. You need to capitalize on the entire booking window, right? So any bookings that come in, your properties need to be competitively priced to have a chance of getting booked. Now, if you do get those early bookings, typically that will give you some momentum, because the way that the OTAs work, if they see that the property is getting booked, let's say for December, for January, for February already now, they're going to be showing your property to more users. That's how the algorithms work. Now, the second thing that you want to do is, outside of like really focusing your pacing and making sure that you're ahead in pacing, the other thing that you want to do is you want to attract longer stays. So obviously some markets, there are snowbirds. The snowbirds from Canada, there's not as many snowbirds coming down this year from what I've seen, because, all the things that have been going on with immigration and with Trump and everything else, like there are a lot of Canadians that don't want to come down this winter. At least that's what it seems like. So snowbirds is definitely a clientele that you might be targeting if you're in a beach market. Like a market like Myrtle Beach typically gets a lot of snowbirds. Florida gets a lot of snowbirds. So if you're in a snowbird market, you want to make your units as attractive as possible for snowbirds to book for like 1 month, 2 months, 3 months, right? So the way that you do that is, and this is something that not a lot of operators do. So if you do this, you can really have a competitive advantage. You look at like what's a reasonable monthly revenue for you to achieve, right? So look at your previous years and look at like how much did each unit make in these months, like in January and February. Now, based on what you've been generating in the previous years, you can come up with a monthly rate that you're going to be happy with. So for example, let's say you have a unit, let's say a 1-bedroom Myrtle Beach. Last year, you had a couple bookings. You brought in like $500 in January, right? Well, if you can get a snowbird in for January at $1,000, you're doubling your revenue, right? That's a big impact. So what you can do is you can set a monthly discount for January, at least on Airbnb. You can do that with rule sets. You can set a monthly discount that will bring your price, whatever your pricing is, that will bring your price down to $1,000 if somebody books it for the entire month. Now, what I don't recommend is that you set a 30-night minimum stay on your units, okay? We've tried a lot of low season strategies across our portfolios. At some level, it makes sense to put, if you're looking to attractive monthly stays, the rationale typically that people have is, well, I don't want somebody to book a like 2-night stay that's then going to block the entire month. Okay. If you have a steady clientele of snowbirds that you know are going to be booking your places, then yes, that makes a lot of sense. But if you have no idea if you're even going to attract any of these longer stays to start with, then restricting your calendar in the hope that people are going to book these longer stays is not a good idea. We've seen the best results from actually offering the most amount of monthly stays that we've gotten from Airbnb and our OTAs, but specifically from Airbnb, is actually on the portfolios where we had a 2-night minimum stay across the entire low season. And that doesn't really make sense because, again, why would you want to allow somebody to book a 2-night stay if somebody could book like a month? Well, here's what I think happens. I think by offering this flexibility, I think that just boosts the visibility of your listing in the search results so much, even though you're allowing people to book the shorter stays, and you will get some blocks. Some of those bookings are going to prevent some longer stays, but still there's going to be enough room in your calendar for people to book the longer stays. Okay. And so what we've seen is that actually opening up your calendar and not putting those restrictions in there, just keep it at a 2-night stay, actually will attract a lot of monthly bookings if you strategically choose your monthly discounts to attract those stays. So be very strategic about that. Use the rule sets on Airbnb at those monthly discounts. I also recommend you not just add the monthly discounts, but also add length of stay discounts directly on Airbnb with your rule sets. The reason why you want to reuse the rule sets is because you do not want to use these settings for other seasons, right? So you only want to use that for the low season. So go and set length of stay discounts for like 3 nights, 4 nights, 5 nights, 6 nights, right? 7 nights. Like if you get a booking that's, 2 or 3 nights that blocks a monthly stay, you could still get a weekly stay. You could still get a 2-weekly stay. You don't only have to get those monthly stays, right? So by adding those length of stay discounts, you're going to be attracting a lot of longer stays because you're probably going to be one of the few operators in your market that are strategically focused on these longer stays for low season, that have these competitive rates so far in advance and are using the length of stay discounts on Airbnb. Those discounts have multiple benefits, right? Number one is like you're going to be attracting those longer stays. It also gives you a breakdown, a line item, a discount on the breakdown of the pricing on Airbnb. So that helps with conversions. So people can actually see that they're getting a discount. But also, I don't know this for sure, but I think that when you add these length of stay discounts, I think Airbnb will show you to more people that are looking for these longer discounts. So to summarize, how do you prep for a low season? Number one, make sure that you're pacing ahead. You got to be pacing at 150 to 250 MPI, market penetration index, depending on how bad, quote unquote, your low season is. If your low season is really, really, really low season, like 20, 25, 30% occupancy, just get as many bookings as possible. Get your prices very, very competitive, maybe even on the minimums, depending on like how your minimums are. If your low season is more like 35, 40, 45-ish% final occupancy in the market, you can get away with more of a 150 to 200 MPI. If your low season is 50% or 60%, then anywhere from 120 to 150 is fine. Okay. But either way, you want to be ahead of the curve when it comes to pacing. Number two is make sure you're leveraging length of stay discounts. Not just the monthly, not just the weekly. Use the 3-night, the 4-night, the 5-night. Really try and get as much occupancy on the books as possible. That's not only going to help you for revenue on the low season, it's also going to help you to keep momentum, keep visibility, keep the reviews coming in, keep the bookings coming in. You keep the cleaners busy as well. That's another factor that not a lot of people talk about, but what we learned from our clients is that it's better for them to have work for the cleaners and the maintenance crews in the winter, because otherwise they're going to find work elsewhere, and then it might be hard to get them back. So it's better to have, even if you're not making a lot of money on those low season reservations, it will help you indirectly. Your cleaning crews are going to be happy, your maintenance crews are going to be happy. Your momentum is going to continue through the low season, which will help with spring and summer bookings as well. All right, so there's a lot of benefits. The worst thing that can happen is that you're just empty. And we've seen this because we have units where the owner mandated a high minimum where we're not getting booked. And you know what happens with those units? There's no bookings from November to March. Comes April, the season is picking up. It's very difficult for us to get bookings because that unit's been empty for so long. The search algorithm has completely forgotten about those units. All right. So people can also not find those units for spring and summer. So that's a big issue. Minimum night stay settings, there might be exceptions, but from what we've seen, we have not seen in any incremental or increase in revenue by restricting and trying to force longer stays in the low season. All right. Again, there's exceptions, definitely. If you're in a market where that there's going to be a lot of snowbirds booking your units, then yes, then it makes sense, right? But if you don't have that, if you're very much relying on the OTAs, you're probably better off by just offering as much flexibility as possible, thereby increasing your visibility and thereby also increasing the chance that somebody who wants to book that monthly stay is actually going to find your unit just because you're more visible. Now, combining these 3 factors, the pacing with the length of stay discounts, strategically choosing those monthly discounts as well, making sure that you're units are attractive. Already now in October, your units should be attractive in January, February for snowbirds, right? Because those snowbirds, they might book quite far in advance. Typically, the booking window is very short in the low season, but that's mostly for the shorter bookings. For the longer bookings, people will want to go to Myrtle Beach or go to somewhere in Florida for January, February. They're looking already. They're looking to book that now or in the next couple months. You want to make sure you have those discounts in place. Combine those things, you're gonna not only crush your low season, we've seen cases where we doubled or tripled revenue for our clients in the low season. Obviously, the numbers are pretty small, right? So in the markets where the summer is like 70-80% of your revenue, doubling your revenue in January, it might not be hundreds of thousands of dollars, right? It might be like 10,000 or 20,000 or 30,000. But still, during those difficult cash flow months, every dollar extra that you make is nice, right? Because you got to keep paying those bills. If you're doing rental arbitrage, you got to keep paying the rents. So a little bit of extra money in the low season can really help. But most importantly, it's going to support you on your bookings for spring and summer. You're probably going to make more money from your bookings that you get in the low season in the spring and summer. Hope that makes sense. Anyway, that's it for today, guys. If you want us to do a free revenue report for you and give you feedback on how you can improve your pricing strategy, go to freewildfoundry.com/report. I'm actually personally doing all of these revenue reports right now because our revenue managers are very, very busy. Definitely we're getting a lot of interest from the industry. We were just at VRMA, by the way, which was amazing. And we spoke to so many awesome companies. So we have a lot of onboardings right now. So I'm doing all the revenue reports, which it's fun for me to do, so I don't mind it. So feel free to submit your information on freewildfoundry.com/report. And we will, generally it takes us about 2 days to do this report. And then we'll present the details to you. If you're doing a great job, we'll tell you, because we're looking for clients where we can increase the revenue by anywhere from 10 to 40%, right? I did a revenue report today where the prospect was doing a great job. Their revenue management strategy was dialed in. Their listings were dialed in. Everything is dialed in. And so, we're going to tell them, hey, you're doing a great job. Keep doing what you're doing. We'll give them some tips on how to improve. We're very honest with our revenue reports. If you're doing a great job and we think that you should just continue to do it and you are a talented revenue manager, we'll either tell you keep doing what you're doing or come work for us. One of the two. So freewyld.com/report. Hope you enjoyed this episode. We'll be back with more episodes, of course, every Monday. We're talking about revenue management. And so hope you enjoyed this episode. Hope you enjoy this new studio look here. If you're watching on YouTube, if you're not, go check it out. Freewyld Foundry on YouTube. And with that said, have a great week and we'll see you next time.
Get paid for your pad.